Volume is a weapon. That was the mantra from the trading businesses, from the heads of trading, and volume is what they wanted. It wasn't really about profit necessarily. It wasn't really about cost. Certainly wasn't about cost. It was about revenue. The way to get revenue is to have more volume than anybody else on the street. So the sell side doing as many trades as possible with as many consumers or customers as they can possibly sell. Some of those products, not necessarily the most economically or socially sustainable or good for the economy, but that was the mantra that people worked through. In '95, I think we started to see the regulation try to put their arms around what was being traded, particularly in the OTC market. But certainly when I started, the operational infrastructure technology was not able to cope with that kind of volume that we were seeing. And the amount of technology investment was reasonably high in trading and pricing. Why? To generate more revenue. But it wasn't really in terms of operational support. So we started in '95, probably with the end of the green screens, but literally we didn't have any Outlook back then. We didn't have any kind of World Wide Web. We had no real technology, no Word, no Microsoft, PowerPoint, Office, etc. It was very much booking transactions in Unix, in the back-end systems to be able to price and manage. And really through about probably '95 to about '98, we saw a new series of technologies. We saw new people developing new technology from whether it's for documentation, whether it's for settlement, whether it's for collateralization, a lot of investment in front office analytics and pricing, which again could then generate more of that volume. But also what we saw as operational professionals back there was a lot of duplication. There were a lot of technologies being built based on silos. So, as John mentioned, there are obviously the OTC products, there's listed products, the exchange products, and even with OTC, there's very much, you've got the credit products, you've got the rates products, you've got the commodities products, you've got the FX products, and you've got the poor old equity products. Each one was investing in their own technology, their own infrastructure. Why? Because the person at the head of the business, who owned the commodities business, had his own budget, both in terms of to generate revenue, but also to pay for infrastructure, whether it be technology or whether it be resources. So they'd all go out and they'd speak to their contacts in the technology space who would deliver their own specific technology for that particular functional area, supporting that particular business. And over really that kind of '95 to '98, we had a proliferation of new technologies because there was nothing really in '95, and then there was so much through '98 and into kind of early 2000s. And what we as operational professionals spotted back then was, why is the technology used for doing confirmations different for an equity derivative versus a credit derivative or an interest rate swap derivative? They're all terms, they're economic information, there are certain clauses, but they're basically pieces of paper that need to be generated, they need to be signed, and they need to be stored and scanned. So we spent a lot of time, probably through late 90s into 2001, 2002, 2003, to start to develop cross-asset class technologies. So getting some of the really good things that were being done in the rates market because it was more commoditized, it was more mature than maybe the credit market and the equities market, and trying to reuse that infrastructure across, from a confirmations perspective, into equities and credit and the like. Similarly within settlement, FX did a very good job in delivering the continuous linked settlement infrastructure, so CLS, being a multilateral payment infrastructure. And that was on the back of a problem that was experienced in FX back in late 90s around the Herstad risk of settling in one currency at one time zone against an FX transaction where you're settling the same, different currency in a different time zone. The fact that I've delivered but I never receive, and I had to deliver because I deliver under a yen time zone, whereas my dollars can be paid same day on the dollars. And of course, I've paid the yen away 2 days earlier. I may not get the dollars back on settlement date. So that Herstad risk created this CLS infrastructure. But again, it was built very much for FX. Back in about maybe 2005, 2006, we developed CLS to be able to support not just settlements in FX, but also settlements in credit derivatives. So quite a lot of thinking across the horizontals from a functional perspective, agnostic of the vertical silos the business they're supporting, to try and drive standards, common technology. And we were very successful. Things like MarketWire, MarketServe, DS Match, some of the trade reconciliations platforms, and even up front, some of the trading platforms, the additions of like TradeWeb and the electronic platforms that trade OTC, trying to do a cross-product provision of prices and transactions to clients. So quite a lot of development, quite a lot of collaboration in the industry as well. We were all facing the same problems. So at the time I was at Merrill Lynch, I was running derivative operations. My peer at Goldman's or Morgan Stanley or JP Morgan, exactly the same problems. We've got lots of people and lots of different technologies, but we've got common problems, common issues internally to try and reduce the amount of duplication in operational processes for a common function. Again, common ways to resolve it, try and drive technology across the asset classes that can be used for the same function. But like what we did back then, we said, well, why don't we work together? So Deutsche and Goldman's and Merrill's, etc. Why don't we create some industry utilities to be able to do this? So rather than us spending the money internally, which is a step forward, because now we've got some money to spend, rather than actually making more efficiency and optimizing that spend across asset class, is a good thing. But why don't we now pool that money in the industry and build things once for the industry? Because I'm only as good as my worst customer, and if my worst customer is manual, then I'm manual. Regardless of how much automation I've got internally, if I'm interfacing with my customer manually, I'm manual. So let's deploy industry technologies, industry utilities, which allow automation for everyone who trades in this market. And again, to support the volume, to minimize the amount of cost, and to be frank, from an operations perspective, to improve the level of control in the market. So I think we made a lot of progress. There's a lot of utilities out there that we built. And really, I think that collaboration was at its peak probably in about 06, 07, 08. Things like central trade warehouses. So you'll hear trade reporting is a big regulatory requirement now under EMIR and Dodd-Frank to provide more transparency of what's being traded in OTC. This global trade repository construct, or the swap data repository construct in the US. Well, back in 06, before they wrote the legislation, we were already building that type of infrastructure as an industry. We built the Credit Trade Information Warehouse with DTCC, where we allowed to do confirms matching. They dropped into a repository from a reporting perspective. We then reused those trades from a reporting perspective for corporate actions. So we did the credit events in that infrastructure. We then worked out what the cash flows were on those transactions, and we then sent them to CLS for a net settlement. So very automated, reusing single infrastructure, doing it once as an industry, and then all interfacing to it singularly. And I think people don't realize that back in 95, 96, it really was very, very manual, okay? When there was a credit event in the market, the terms and conditions in the legal agreements were about saying you need to send a NIPS and a NOPS notice, a notice of intended physical settlement or optional physical settlement. And the way you did that was basically sending a fax. And you had to do it by 3 o'clock. And if you had 500,000 CDS, yeah, which have all hit a default on that day, by 3 o'clock you had to send all those faxes. So we had all these faxes, literally physically trying to get through fax machines across the industry globally. An absolute operational disaster. And guess what? A lot of credit events were not fully executed on time because of the manual and the restrictions on using fax technology. By using the Central Trade Information Warehouse, we got trade confirmed, we got ability to automatically trigger those credit events. Both parties would see it automatically, and then we'd be able to then calculate the cash flows and automatically settle them. So a lot of infrastructure change, a lot of consolidation, a lot of good efforts. The problem we had was obviously 2008. We all regressed inside our shops in 2008. When the world financial crash occurred, we all had to actually forget about external collaboration, forget about working in the industry and working together. We had to sort our own shops out. What are we exposed to? Where are our risks? What business do we want to trade in? What products do we want to offer to our clients? Which clients do we want to trade with? Which regulated authority we're going to trade under? What new regulations and controls we have to put in place to support those new regulatory requirements? So really, from about 08 to 14 to today, we've been in a period of inward navel-gazing to sort our own shops out, so not working collaboratively, and under a lot of cost pressure because, as John said, the cost of complying with the regulation is significant from front, middle and back offices, from technology, from trading, from sales. Who's going to bear that cost? At the moment, it's all market participants. It's a lot of money. And I think what I've noticed, I suppose, in the last probably 6 to 9 months, as people have started to realise that we're complying with the rules and the regulations at a kind of C- level. Nobody ever wanted to get an A+ in meeting regulatory requirements, okay? It's too costly, and if nobody else is getting an A+, then why get an A+, okay, right? Just make sure you get over the bar so you're compliant, which is the C-. But what happened was we spent money on elastoplast and sticky tape into our own shops. We didn't spend it wisely or optimally or sustainably, but it came at a cost. Then I think what happened was, in the market, all these new technologies started to take off. They had time to think, to develop. The whole kind of big data, the use of data, the analysis of data, the analytics, yeah, the core processing, the memory capability, the server farms. The amount of information that's being produced and generated now is so much more sophisticated than it has ever been. And I think we took our eyes off that external market, to be frank. They had time to think about it because we were worried about internally. And they now, probably through that period into 11, 12, 13, 14, started trying to sell us all these new tools and these new technologies. And of course, we don't want new tools and technologies, to be frank. We think we've got the right infrastructure, but they have actually got very good infrastructure. So I think what's going to happen over the next probably 4 years is a next wave of working in industry and looking collaboratively together again in the market and saying, I spent all this money through 8 and 14, it's got me in the C-, but I can't afford to do this. As revenues continue to fall off, as costs don't go down as sharply as they would like to do, the profit is being squeezed. So again, we need to work much more collaboratively across the market to be able to do things once. Okay, again, joint ventures amongst industry participants. So exactly what we were doing back in 2008, delivering those kind of combined solutions to the market, we've got to do it again in the next kind of 4 or 5 years. And I think it's probably slightly different to what it was then. A lot of it then was kind of brute force, major dealers getting together, they had the deep pockets, whatever the G14 or the Fed 14 dealers say and have appetite to spend on gets developed, gets built out, will then be used by the market. I think what's going to happen here is probably there's 2 more parties to the table to develop this industry infrastructure and this collaboration. One who wasn't at the table originally is the clients, the buy side, okay? They're in this together with us, okay? In the past, certainly through 98 until about 2012, we were very much the ones driving the agenda, driving the infrastructure, spending all the money to build everything and develop stuff out. John quite rightly said, okay, right, the buy side is as much culpable in this to get ourselves out of this problem as anybody else, okay, right? So I think better collaboration with buy side and sell side on what these external utilities, technology consolidations need to be, and the industrialization of that infrastructure. I think the other guys who are going to be at the table is the regulators. I think it's remiss of us to ignore them. I think we should be at the table and make sure that what we design, and what we build, and what we collaborate and facilitate, what we deliver as industrial strength technology is going to meet their needs today and in the future. I think if we'd brought them closer to us probably back in 2005, 2006, certainly, when we were building things like the Credit Trade Information Warehouse across the industry, they would have got a much more comfortable feeling that we were, particularly operational infrastructure, we were in charge. We knew where we were going. Unfortunately, we had to down tools a lot of that infrastructure across the industry, focus our internal shops for a good 3 or 4 years to make sure we can stabilise. But now we need to move forward again. So with those regulators and with those the buy and the sell side at the table. And the last thing to mention really is that there is an awful lot of really good technology out there now as well. I was at a Fintech startup presentation about 2 weeks ago. Guys in kind of jeans and sneakers, not shirts and suits and ties. 90 days, they've developed, 11 solutions which have got real business benefit in the financial services market, which will absolutely change the way we do and the way we manage and support the trading businesses going forward. They have much more out-of-the-box thinking. They're not short with how we trade today, who we trade with, what it was done in the past. They're literally just leveraging all the new tools and technologies that are out there, okay, right, coming up with real business problems. We see it with PayPal, yeah. We see it with Pingit. We see it with Google. We see it with Apple, to be frank, yeah. The way they've disintermediated the music industry by getting the buyers and sellers much closer together, using their technology and their capability, yeah. That's what's going to happen in investment banking. So I think it'll be new technologies. I think it'll be the buy side. We've got to listen to them and work with them because they're in it together with us as the sell side. And I think the regulatory community.